Hi, in this chapter we will talk about the periodicity assumption or the time period assumption, and we will also discuss the accrual basis of accounting and the cash basis of accounting and see the difference. We will also learn about adjusting entries and the major types of adjusting entries, mainly deferrals and accruals, and at the end we will prepare a trial balance and an adjusted trial balance, which is usually used in order to prepare financial statements. Before we talk about accruals, the life, as you remember from previous chapter, we said that corporations, they have an indefinite lifetime. However, because it's hard to deal with an indefinite lifetime, accountants, they found it useful to split the life of a company into artificial periods. Now, that creates an issue. So those artificial periods are usually like a month, a quarter, or a year, and that makes it easier to handle the information and to report on a timely basis. Now, the problem is that using these accounting periods requires some kind of adjustments. We need to learn, or to especially when we have events that occur or that roll over into the following accounting periods. Say if you pay in advance something in advance, if we could wait until the end of the life of a company, everything would be easy and it would be clear, so we wouldn't need to make any adjustments. But because of these these time periods, we need to provide periodical statements, and as a result, sometimes we may need to make certain adjustments. Take, for example, the management's needs for monthly reports. The IRS also, they require annual tax returns. So we will need to make those adjustments in order to say, okay, what did happen during this accounting period? So if we're talking about the month of April, we need to know what revenues we had during that month and what expenses we had that month. Basically, we need to know what transactions are to be recorded for the month of April. Now, monthly and quarterly time periods are usually called the interim periods. The annual time periods are the fiscal years. Now, a fiscal year doesn't always have to be exactly like the calendar year. For many companies it is. However, a lot of companies, they have different fiscal years. For example, it could start from July 1st until June 30th of the following year. Basically, it is 1 year that accounting transactions are recorded for that 1 year. And publicly traded companies, they have to prepare and publish quarterly as well as annual financial statements. So, for example, the time period assumption states that revenue should be recognized in the accounting period in which it is earned. Expenses should be matched with revenues. The economic life of a business can be divided into artificial time periods. The fiscal year should correspond with the calendar year. Well, we know that it doesn't talk about the revenues or the expenses. The time period assumption is actually C, because D is false actually, because fiscal years, they don't always have to correspond with the calendar year. Now, under US GAAP, companies are required to use accrual basis accounting. And what do we mean by accrual basis and cash basis accounting? Accrual basis accounting, simply states that the revenues must be recorded when they are earned, and expenses must be recorded and recognized when they are incurred. So basically, when you provide a service, you earn the revenue. When you make a sale, you earn the revenue, regardless of whether you have received the cash or not. And same thing applies to expenses. Whether you have paid in cash or not, as long as you have received the service, as long as you have incurred those expenses that are associated with generating the revenues, you have to recognize those expenses for that accounting period. So basically, the transactions recorded in the period in which they occur, where the event occurs, and not when the cash is exchanged. On the other hand, cash basis deals with cash. Basically, revenues are when you receive cash. So when you make a sale, it doesn't matter as long as you haven't received cash. So for cash under cash basis accounting, you only record revenues when you actually receive cash, and you only recognize the expenses when you pay in cash. So it's cash in and cash out. And throughout this semester, throughout all the courses, we will be dealing with accrual basis accounting, because under cash basis accounting, we cannot under US GAAP, companies are not allowed to use cash basis accounting. However, one would think about cash basis in a way like, why would anyone want to use cash basis? The thing is that here, cash basis could be misleading. How? Take for example a transaction like how most companies do business. They usually make a sale or provide a service, and then they give their customers 30 days or 60 days in order to pay. So they won't bill them immediately. What happens under cash basis? Under cash basis, this will not be recognized at all. At the same time, expenses. If, for example, a company buys an insurance policy, so this insurance policy for, let's say, $1,200 for a whole year. According to under cash basis accounting, the company would recognize the $1,200 as completely as an expense in the first month, but for the subsequent months they won't have expenses. That will be a little bit misleading. Think also about equipment. So if the company buys a truck to deliver packages, let's say that UPS or FedEx or USPS, they buy a truck in order to for their main line of business, which is delivering packages, which would lead to revenue generation. So under cash basis, the company would recognize the full price or the full cost of this truck in the first year. However, let's say that the truck is going to be used for 10 years and UPS bought it for $50,000. Does it make sense to charge the whole amount for the first year and the remaining year and the 9 years where the truck will be used to generate revenues? Shows that there was nothing. In this case, what would happen is that in year one, basically, in year one, the company will have expenses of $50,000. On the other hand, let's say that they had revenues $10,000. In this case, they have a net loss of minus $40,000. Now this is a little bit misleading, because in year two, the company would have expenses 0 and revenues. Let's assume that they also get 10,000. In this case, they have net income equal to 10,000. Now this is assuming that there are no other expenses. Now what the problem here is that if anyone looks at the performance of this company, they look at the first year it was minus 40, second year it's plus 10, so they expect that it will continue to grow more or less like that in this same pattern. But this is not the truth. The truth is that what happens is that the year 3, so this is year 2, year 3, it will still be 0 and 10,000, which would make it again 10,000. This is a little bit misleading. Under accrual basis, the company would record it as the revenues are record the expenses as the revenues are generated. Now, however, cash basis accounting is sometimes appealing because it's very simple. It's easy to it's very easy to basically to do the math here. You receive cash, you recognize the revenue, you pay cash, you recognize the expense. But whenever you make a sale without receiving cash, you don't have, for example, receivables. And this is usually like individuals and small businesses, they may use cash basis. However, medium and large businesses, they always use accrual because it is under US GAAP, it is required. Throughout this semester, we will be talking mostly about accrual basis accounting. And we will be recognizing revenues and expenses according to accrual basis accounting. Now, under this basis of accounting, the revenue recognition principle states that the company should recognize the revenues when they are earned. So basically, it's when the service is performed, regardless of when the cash was exchanged. So this is in the case of a service, and in the case of a sale, same thing. When the company sells a product, the revenue is recognized when the product, when the sale is made, and not when cash is actually exchanged. And it has so this event. The event that has happened, which is providing a service or making a sale, it should be recorded in the same accounting period. And this is also more or less similar to when we talk about expenses. So here we have the expense recognition principle. It says that, or sometimes also called the matching principle. This is where the expenses, they follow the revenues. And what do we mean by that? As you remember, expenses, they are resources that the company uses in order to generate revenues. And as a result, all the expenses that the company has incurred to generate certain revenues, they have to be recorded at the same time as those revenues. In other words, the effort, they must be matched with the results, or expenses, they have to match the revenues. And whenever the expense is not paid in the same accounting period, then it becomes a payable, it becomes a liability or an obligation that the company has to fulfill later on. This is a summary of what we have been talking about. This is where we talked about time period assumption, where the economic life of the business is split into artificial periods of time, and the revenue recognition principle says that the revenue has to be recorded in the when they are earned, basically when the event occurs in the same period that the event occurs, and expenses, they have to match or follow these revenues. And this is what we mean by the revenue and expense recognition under the accrual basis under US GAAP. An interesting point here to discuss is where accrual basis accounting is manipulated in order to cook the books. And what do we mean by cooking the books? Basically manipulating the numbers to mislead investors and creditors and other stakeholders. So for example, consider the scenario where a company does not earn enough revenues during a certain year. Yeah. Most companies, they have as a goal in a way, they try to meet or beat financial analysts forecasts. And those financial analysts, they analyze the performance of the company, and they predict a certain earnings, a certain number basically for these companies. And then the company, if they fall short, their stocks are affected, and basically their stocks are usually they drop. Stock prices drop. To avoid that, certain companies, sometimes management, they can, for example, boost their sales. Take, for example, a scenario where a company, let's say a computer company, they cannot, they fall short on their forecast, and in order to boost their sales, they can, for example, go in December and make a huge sale. What happens is that because of this huge sale, a lot of people, and on account, for example, it's not just a huge sale, but it's also on account, and without basically taking into consideration the risk of people defaulting and not paying their debts in the future. So what happens is that their earnings will rise at that point a lot, and they will meet their financial analyst forecast. The financial analyst forecast. What happens? The problem that could happen is that, what about next year if a lot of people default? At that point, they will not be able to pay their debts, and the company will rather be losing money. So this is a scenario where, in order to improve their earnings now, they may be eventually hurting hurting their future performance. And as we can see here, Krispy Kreme, they also once there was allegedly, basically what they did, they used to boost their sales at the end of the quarter, and by striking a deal, for example, certain places where they would strike a deal with their wholesale customers, and they would send them large amounts of donuts that would be returned right after the quarter has ended. But that would also lead to a loss in the sales. Eventually, it would lead to a loss, but at the for the short time, it would boost their quarterly results. This is just to see if we still, this is a summary now. Let's look at this question. Which of the following statements about the accrual basis of accounting is false? Events that change a company's financial statements are recorded in the periods in which the event occurred. Revenue is recognized in the period in which it is earned. The accrual basis of accounting is in accordance with generally accepted accounting principles, and revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. As we can see, under the accrual basis accounting, only the last one is incorrect, because this is the cash basis accounting. Now let's consider this small problem. Lamb Company had the following transactions during 2011. Sales of 9,000 on account, collected 4,000 for services to be performed in 2012, paid $1,250 cash in salaries, purchased airline tickets for $500 in December for a trip to take place in 2012. What is Lamb's 2011 net income using accrual basis? So first of all, what they are asking us is to calculate the net income. So this is what we're looking for. How do we solve this? They are asking us for the net income, and under accrual basis. So in this case, we'll look at the transactions one by one and see if we can if we can recognize it under accrual basis for 2011. So now we are looking for 2011. The first one is sales of $9,000 on account. So those are sales in 2011. As a result, we include it in our calculations. So this is 9,000 plus 9,000. Collected $4,000 for services to be performed in 2012. So the services will be performed in 2012. As a result, we don't recognize them now, and we don't include them in the net income. Paid $1,250 cash in salaries. So this was paid now. This is minus 1,250. Purchased airline tickets for $500 in December for a trip to take place in 2012. Once again, this will be used, the event will take place in 2012, and we do not include it in our calculations. This is why the answer is 7,750. This is a list of concepts that we need to match with their definition. So accrual basis accounting would be which one? Accrual basis accounting is where companies, they have to record the transactions when they as they occur, and this is why it's F. The calendar year, this is from January 1st and ends December 31st. That's E. Time period assumption, this is where the lifetime of the business is split into artificial periods. It's C. And the last one is expense recognition principle, which is B. This is where the effort, they have to, or let's say the expenses, they follow the revenues. So so under the accrual basis accounting, we need to record revenues and recognize expenses in the periods where they are earned and incurred respectively. And in order to do that, in order to make sure that the revenues and the expenses are recognized in the period where the event has occurred, sometimes we need to make some adjusting entries. Originally, the trial balance that we studied so far includes information from the original entries, and as a result, by the end of the accounting period, the information in that trial balance may not be up to date or complete. And the reason for that is that certain events happen on a daily basis, but we don't record them. They don't need necessarily happen on a daily basis, but we don't need to record them every day or every time we use them. For example, when we use supplies, or when we have salaries or interest, when interest starts accumulating. We wait until the accounting period, the end of the accounting period, and then we recognize them. In certain cases, there are expenses that we pay in advance. However, so we pay them in advance, but we recognize them later on, such as insurance. When we pay insurance in advance, we are using it subsequently, but we don't record it at the same time. Then we also have certain revenues that we might be paid, for example, in advance. And we have already talked about prepaid expenses and unearned revenues, and we will talk about that a little bit more in advance later on. We also have sometimes certain items that will not be recorded until later on. For example, when we receive a utility bill for the future or something like that. And this is why companies, right before they start preparing the financial statements, every time they make certain, basically they have to prepare those adjusting entries that would fix this information and would update the trial balance. And usually those adjusting entries, they include, or they would include one income statement account such as revenue or an expense, and one balance sheet account such as a liability or asset. There are two main categories of or types of adjusting entries. We have the deferrals and the accruals. So deferrals, they would include prepaid expenses and unearned revenues, whereas accruals, they include accrued revenues and accrued expenses. So accruals, as the name suggests, this is an accumulation of revenues or expenses that have not been recorded or recognized yet. Whereas with prepaid expenses, this is when we pay expenses in advance. In return, this is when we pay in advance in return for services or products that we will be receiving in the future. Unearned revenues is where we actually receive cash, when the company receives cash before they actually provide the service or make the sale. So it is actually before the event has occurred. And as you remember, this is from the this is the trial balance. We will use the trial balance here in order to as a starting point, and then we will update this information. Once we have this information updated, we will end up with the adjusted trial balance. Now, we will start with the deferrals, and deferrals are costs or revenues where the recognition is postponed. In other words, we recognize them at a date later than they actually occur. We need to make therefore, basically, we need to make adjustments to record the part that was incurred or recognized during the current accounting period. Take insurance policies, for example. You start, let's say you pay in advance for a whole year. So basically what you need to do in this case, you need to recognize the part that was used during this month. Or let's say unearned revenues. This is where you get cash in advance for services that you will provide in the future, but you will start earning it as you start providing services, and we'll talk about each one of them in detail. So prepaid expenses, we talked about in the previous before we talked about prepaid insurance expense. So in this case, this is where we pay the cash first, and then so we record it as an asset first, and then this prepaid expense, we start expensing it at the end of each accounting period. So this is basically an asset that we will be using in the future to generate revenues. And there are several examples of this. We talked already about insurance. We can talk about supplies. We have equipment, building, rent, etc. So, for example, those. Well, let's talk about supplies first. Basically, let's say that we buy an amount of $5,000 worth of supplies. The original entry was where we debited. For the original entry, let's say that we bought them cash. So it was we debit let's say October 4th, we debited supplies 5,000, we credited cash 5,000. However, during the month of October, so this is the original entry, and the trial balance will show at the end that supplies is 5,000. But let's say that at the end of the accounting period, at the end of October, we found that we have used $2,000 worth of supplies. Do we still have $5,000 in supplies? That would be misleading. It's not correct. So we need to adjust for that. We need to decrease supplies by 2,000. Those are the supplies that were used during this time. And where does that go? Well, we use those supplies in order to generate revenues, so those go to supplies expense. As a result, what we do, we decrease supplies by 2000 and we increase supplies expense by 2000. And prepaid expenses, those are the costs that would expire. Usually they expire either with the passage of time or through use. Passage of time, for example, when you prepay insurance policies or when you prepay rent. Or through use, this is like supply, like this example here where we used supplies. Now, in general, it is impractical and it's not efficient to make daily entries for the supplies that we have used. So every day, every time, you're not going to make a journal entry every time you use a pen or a pack of papers. So what do? You wait until the end of the accounting period, and then you look at how much you still have on hand. So this is where you look at the remaining part. So at the end, you see that this is how much you still have. Let's say at the end, we had the value of the supplies was $3,000. What does that mean? That means that during the month of October, we used $2,000 in supplies. And as a result, those are supplies expense. Those are expenses that we use in order to generate revenues. Now, so this is why always, as we did before, what we did, we needed to, the adjusting entry, what we needed to do was to decrease the asset supplies. In that case, it was supplies. So we decreased, so here, an asset account. In the example, it was supplies. And we increased an expense account that was supplies expense. Now, as you remember, expenses are debit. So in order to increase them, we debit the account supplies expense and we credit the asset account supplies in order to decrease it. So as you can see here, this is the unadjusted balance here. This is the unadjusted balance of the asset. It was supplies. Here we credited the asset and we debited the expense. So let's look at this example. Pioneer Advertising Agency purchased supplies costing $2,500 on October 5th. Pioneer recorded the payment by increasing or just doing debiting the asset supplies. This account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. Whenever you see this expression are still on hand, it means this is what you are left with. This is the ending balance of supplies. And the difference between the ending balance and the original balance is actually the amount of supplies that was used. So here, if we leave the trial balance without adjustment, well, the information would be wrong. Actually, it will be outdated because it will reflect the time where the supplies were bought on the 5th of October and not at the end of the month. So in order to fix this, we make a journal entry and like we said, we need to, so the amount, the expense here, so the supplies used are 2,500 minus the 1,000 that remains, which is $1,500. This is the amount that was used for during the month of October. As a result, we need to increase the expenses, supplies expense by 1,500. So we debit supplies expense 1,500 and our supplies, the asset account supplies decreased by $1,500. As a result, we credited $1,500 and that would be the adjusting entry. As you remember, it will not be practical to make daily records. This is why the companies usually they wait until the end of the accounting period and then they count whatever supplies they had or inventory. And the difference between the two would give us the supplies expense. This is how we made the analysis. We looked at the equation. Supplies decreased by 1500 and expenses that the supplies expense increased by 1500. Remember that this minus here reflects or indicates the negative effect that expenses have on stockholders' equity, because in this case stockholders' equity will decrease by $1,500 and assets, they decrease by crediting them, and debits, they increase expenses. So we debit supply expense and we credit supplies, and this is how we post it to the ledger accounts. Now, as you can see here, it is important to indicate that this is an adjusting entry to make sure that to make sure that this is distinguished from the original entries. Without those adjusting entries, the net income would have been overstated by $1,500. Why? Because we would have the same revenues, but expenses would be understated by $1,500. And the same thing could also be said about assets. So assets would have been overstated in that case. So assets would have been overstated by $1,500, because in the trial balance we were saying that we had an asset value of 25, an asset account of $2,500, whereas in reality we only had 1,000 in that account. On October 4th, Pioneer Advertising paid $600 for a 1-year fire insurance policy. Coverage began on October 1st. Pioneer recorded the payment by increasing or debiting prepaid insurance. This account shows a balance of $600 in the October 31st trial balance. The insurance of $50 expires each month. Here, this is similar to the example that we discussed before. This is where the company paid in advance a 1-year insurance policy. Now, this insurance policy will have to be split over the useful life, or basically over the time that it will cover. So every month, $50 of insurance will have expired. Now, on the unadjusted trial balance, it reflects the original value of prepaid insurance. This it will show it as $600. So the trial balance does not have the most up-to-date information where it would show that we have already used this month. The month of October has already been used. So the insurance policy used to cover 12 months, but after the month of October has passed, we are left only with 11 months coverage in that insurance. And this is why it was originally recorded, like we said here, when we bought, let's say that we bought it as cash, it was prepaid insurance was for 600, cash was credited 600. But now we have to adjust for that one. We need to decrease, we need to expense the part that was used in October, that's $50. So as a result, we decrease prepaid insurance, which is an asset, so we by $50, and we have used this as insurance expense. So this insurance expense has increased by $50. So we debit insurance expense 50, we credit prepaid insurance 50. And the analysis for this one would be as usual. We have our asset prepaid insurance decreased by $50, and so it will be credited. Insurance expense has increased by $50, and so it will be debited. Once again, we post this to the ledger, and again remember that we have here adjusting balance. And as you can see, we still have for this transaction as well, we have total credits. So credits and debits should also be equal. Again, to maintain the equality of total credits and total debits.